Hello, everybody. We're missing quite a few people today. My name is Julianne Peterson. I am your host. I'm with Old Capital Lending. We have closed many, many deals, and we are interested in helping you. We've closed $1 billion the last couple of years. We do specifically in multifamily, but we also dip into storage, mobile home parks, office, retail, and industrial. So if there's something that you're working on, please let us know. I'd love the opportunity to help you. So I do want to, normally we say hello and greetings and what are you guys working on? But I think that Chris has so much information, and the last time we kind of ran out of time, especially with some of the questions. So I thought we would say hello real quickly. Shaka, where is your backdrop? You usually have a backdrop. No? Yeah.
Busy and active over here today, so today.
Okay, all right. Well, I thought what would be really helpful is to kind of first ask some questions, get your ideas, and then before we finish, we're going to come back around, because maybe the stuff that Chris has presented, you might be saying, oh, wow, I think I would use this. Okay, so let me first talk about Chris. Chris is the editorial director at Yardi Matrix, and hopefully you guys all know the power of Yardi Matrix, and he's responsible for overseeing the market research and data analytics, as well as the editorial composition from Yardi Matrix, commercial property executive, and multi-housing news. He also facilitates the expansion of Yardi Matrix reporting suite and provides in-depth analytical tools for clients across the commercial real estate industry. Before joining Yardi, Chris served as a portfolio manager for the Bank of New York Mellon. He managed fixed income portfolios for municipal and public sector clients across the United States. He holds a bachelor's degree in economics and a master's degree in finance, both from the University of Denver. So what that says is Chris is one smart dude and knows his. Okay, so the question is, and I want you guys to think about this. We're trying to figure out how you can use Yardi in your daily living in multifamily. And if it's not multifamily, maybe we can get other information to you in other sectors. Is that correct, Chris? Other sectors, you could provide that as well.
Absolutely, office, industrial, and self-storage as well.
Okay, so you have 5 questions. There's 5 things that I want to ask. What is most important? Okay. All right. Let's get ourselves muted there. Okay. So let's see. How should we take this poll? You raise your hand. How's that? Okay. So here we go. How would you rank these metrics in an order of importance? So write this down, you guys. In information that you're looking for, the data of the information for loan details and maturity, that's 1. Loan maturity data, loan details, that's 1. Is that of importance? Second is property owner and management contact information. Is that important to you? Where of the 5 is that number? Third one, property occupancy. Is that number 1, 2, 4, 5? The next one is property rent by unit type. Is that important? Property rent by unit type. Is it a 2-bedroom, 1 bath? Is it a 1-bedroom, 1 bath? And then the last thing is recent sales. So I'm asking these questions so we can give feedback to Yardi, because maybe they can put together a product that is something that is what you need. Okay, so on loan details, maturity date, who thinks that's the most important thing for you? Okay, how about property owner and management contact information. Is that the most important? Not, is that your second? Hutch?
I was saying that's number 2 for me, sorry.
Number 2, okay. How about property occupancy? Who has that as number 1? Ooh. How about property rent by unit type? Recent sales.
Yeah, I said it number 1.
That's your number 1, recent sales. Chris, you writing this down?
Yeah, this is helpful.
Okay. So number 1, recent sales is your most important. Yeah?
Yes.
Okay. Number 2.
I think that's a good starting point.
Okay.
For me it is. At least for me it is.
Number 2, you're saying is recent, property occupancy? Number 2? What did you say, Hutch?
Property owner.
Property owners, number 2. Everybody agree? Owner and management, yeah?
Yeah, I agree.
Okay. Occupancy is next of importance. Property rent unit type, what do you got? So, Noane, what do you got? Noane,
Yeah, for which one? That was my number 2.
what's number 2 for you?
Rent by unit type.
Rent by unit type. Okay. You got that, Chris?
Yep.
Okay. Property occupancy, is that important to you guys?
That's my number 3.
No? Loan details. Loan details, is that important to you guys?
I got loan detail as number 3.
Okay. Loan details number 3.
Occupancy number 4.
Anybody else have thoughts on that? So recent sale, property management, loan details, property occupancy, is that your number 4? And rent by unit type.
For Hutch, that it is.
All right, that's Hutch's deal. You guys okay with that? Anybody have any input on that? Okay. All right, so the second question is, how much would you be willing to pay for a comprehensive property report, including all of the metrics that I just spoke to you about? So if you're looking at one item, one deal, right, Chris? One place.
Yep.
How much would you pay for that information? The loan details, the property owner management, the occupancy. Would you pay $100 to $250, $250 to $500, or $500 to $1,000?
Are we talking about a year or a month?
For
And are we
one,
talking about
for
one property?
one property, you'd get a report. How much would you be willing to pay?
Oh, okay.
Well, I'll throw in the Neighborhood Scout does do one for $40. So it
Who-
is
Who does that?
a Neighborhood Scout.
Neighborhood Scout does it for $40, Chris.
Yep.
Okay.
I'm sorry, I'm late. Did you guys throw in like rental comps into that first question that you addressed?
Well, no. Would you say that, Chris? Rental comps on that?
Yeah, so we would be looking at the rent by unit mix for that property, and then
Rent by unit mix.
a
Okay.
local area comp set as well.
Okay. So,
Would you guys have operating expenses per unit? Would it be possible to add that?
Operating expenses is a data metric we track, and so that could be added, yes.
so with this information, you've got a deal and you want to know where it stands for occupancy, you know, the area, the metrics, the loan details. What would you pay for that? Now, that saying that you don't have a Yardi, that you could do this yourself, but you're willing to get the information by paying a little money, and it's given to you. Remember, you have to provide that you're a professional and you know all these details to your investors. So what is it worth to get accurate information instead of sitting in the Google search? You have somebody doing this for you. making you look like the expert. How much is it worth? Is it worth 100 to 250? Who wants to pay that? 250 to 500.
I'll pay that.
You pay that, Chris. Tim pays that, Chris.
Yes.
Who's going to pay 250 to 500 for one, right, Chris?
Yep, this would
Yep.
be a one-off report.
Anybody pay 250 to 500? Anybody pay 500 to 1,000? You don't want to pay any more than
Same
that?
until I see it.
Okay, so Jeremy says 250 to 500. Recent sales, rent per unit. So 250 to 500. So 100 to 500 is your range. Okay.
Great.
So if you were looking to find out about a market, you guys, so you don't know exactly where you're going. I don't know. I want to go to South Carolina. Would you be willing to find out? That would include all those metrics for that market and that sub-market so that you didn't have to do all the work. Would you be willing to pay 500 to 1,000? Would you pay
Is that a one-time report or a over a period unlimited access to an area?
That would be a one-time report.
One-time report.
One-time report.
So I'm looking at, hey, things have changed. COVID has changed everything. I need to look at the market. I'm searching out on the East Coast. Chris, can you give me an update on this market? How much would it be for you? How much would you be willing to pay for that information where you do not have to open up Google search, call the police? How much would you pay? Chris Roberts, what would you pay?
Good choice, Shirley. Good choice.
You're muted,
Chris
Chris.
Roberts.
Chris, you're muted.
$1 million.
Exactly. You would pay anything because it's worth $1 million to
It's
you, right?
relative. I mean, it depends on the return you're going to get. I mean, if you're working deals, 100, 500, I mean, it's like a sales deck. Would you spend $2,000 on a sales deck that's going to help you raise $2 million, right? To buy a $10 million property. So
Exactly.
I don't have a number for you. If I saw the data, I could better tell you. But for me, if I had to spend $100 to $300, that would seem reasonable to me. But if it was a bigger deal, I might be willing to spend $1,000. It just depends.
What is your
Yeah,
time?
that's
What is your time worth to get real data? It's not skewed by your broker. It's not skewed by the police that don't want to show that there's high crime in that area. This is analytic data that this is how things are going to be driven moving forward. We're not making guesses anymore. This is how we're going to be moving forward in the future. So if it could be given to you and all of it is up to date, would you be willing to pay $100 to $1,000? Sounds like you guys would be. Okay, great. What would be your preferred method of communication? Would it be email, text, phone call? What do we got?
Probably text.
Slack.
Slack, really? Okay,
Yes.
Slack. Chris said email. Anything else? Phone call?
I like email.
Email.
Email with an option of a phone call.
Email. Okay, Chris.
Or a
email.
portal
Because
with a text reminder that there's data for you to review.
I like that.
Oh, a portal.
See?
So
Smart
you
man.
would have access to a portal.
Yeah, you just get a text and it says you have information in the portal to review, and
Okay.
then you can go at your leisure or an app or whatever.
There you go. Okay.
And
good.
that would provide for future transaction as well too. Just have all your data in one location. Then that'd be great. Hey, great idea, Chris.
Thanks.
So at what point in the investment or deal process would you want access to this data? Would it be in the discovery, deal underwriting, due diligence, after it's been accepted? When would you want this data information? Rick?
I think if you're studying the market, you want it pretty early in the process. So
Okay.
I would say straight away.
Okay. I would agree. Anyone have a, Daryl? What do you got?
I'm going to I'm going to stay out of this only because I'm a KW commercial agent, and I have access to CoStar nationally. Okay, so I'm gonna stay out of this and stuff like that.
Okay. Is there any rebuttal from Chris Nebanzahl?
No.
Okay. All right. Well, without further ado, you guys, we have the champion of all champions. This guy, Chris, if you've never met him, Chris is a rock star and you want to know him further. This is only an introduction. He was here last month. He talked to us about March. So he's here to talk to us about April. And by the way, we really thought that the world was going to crumble between April and May. And I would say that that's not what has happened. And I'm really excited to hear about what's going to happen moving forward. June, July, August. I think Chris has his what do you call it? Your ball, your crystal ball. Every time I try and go my crystal ball, I look in there and there's a guy flipping me off. So I don't get much information out of it, but I'm thinking that Chris has a much better battery charger than I do. So you guys, I want to give you quality information, and Chris is here to help you. He is very capable of taking your calls after this as well. So he's opened himself up to providing content for afterwards. So Chris, I'm going to push it over to you, and I will have you, have the speaker view, and then you're on your way.
Great. Well, thanks, Julie. And I appreciate you inviting me back. I certainly appreciate being here and talking to everyone on the call tonight. If you mentioned I had a crystal ball, that crystal ball has been anywhere from incredibly cloudy and stormy to somewhat cloudy and hazy. So I'll share with you what I can, and I'm certainly open for questions. And please feel free to interrupt, and we can also take questions at the end.
So the only thing I would say is that you're coming back. I've already told you this. You've already committed to me, or I've committed you to me, for next June, you guys. So, or for June coming up. So he'll have information that he'll be sharing for May, right?
Yep.
And then we'll see if there's anything else that you guys want Chris to give you. But before we go any further, Chris will make available a 10-city list of the top 10 cities, right, that you should be looking at.
Yes.
So Chris will give you his information at the end of how to contact him. Now I'm going to zip it. Thank you. Carry on.
And thanks, Julie. And you're absolutely right. I'll certainly share the deck that I present today, and happy to take calls offline individually after our meeting as well. Can everyone see my screen okay before I get going?
Yeah. We're good.
All right. Yep. So let's get into it. The house view, the perception that we have of the economy and the housing market is a bit of a twofold story right now. Certainly from an economic standpoint, things look rather dire. We've seen unemployment claims near 40 million since this whole lockdown, COVID, the great lockdown began about 2 months ago. But on the multifamily side, as Julie mentioned, things are actually doing okay. Multifamily will likely outperform other asset classes, and collections have been actually doing better than many of us had expected, and certainly are in line with what people could have hoped for. A lot of that I expect is being backed up by really unprecedented stimulus. 12 years ago, when we were coming out of the Great Recession, and we saw things like quantitative easing for the first time, and everyone said, oh my gosh, wow, what is this quantitative easing? The Fed is printing money. This is unprecedented. Now we're in a period of even further unprecedented stimulus. The Fed is doing everything that they can and everything that they need to do to stabilize markets. The fiscal stimulus has also been unprecedented. The CARES Act, where people were sent checks for $1,200. On top of that, unemployment benefits. On top of the state unemployment benefits, $600 per week have been added by the feds. So it'll be very interesting to see what further stimulus comes in the next couple weeks and couple months. As recently as I think last week, the House, mostly Democrat-led, put forth a $3 trillion stimulus package. I don't think that will be approved by the mostly Republican-led Senate, but it would not surprise me in any stretch if there was some sort of additional stimulus approved. So I don't think it'll be $3 trillion. I don't know how much it will be, but I expect it will be something. And I expect that there will be more direct payments to American citizens, and I expect there will be additional unemployment benefits. Again, that's really what's propping up the collections on the multifamily side and keeping multifamily fundamentals in okay shape. But as we'll look in the data as we get further into the presentation, the fundamentals are starting to show cracks and starting to deteriorate. So with that said, let's start talking a little bit about the economy and the financial markets, and then we'll jump into the multifamily side. So as I mentioned, I'm just going to move my screen a little bit because all of your faces are covering up what I'm seeing. But as I mentioned, nearly 40 million people have filed for unemployment in the last 2 months. Just to put that into perspective, 10 years of economic growth coming out of the recession created about 22 million jobs. And this was the longest recession we'd had in the post-World War II era. And we created only half of the jobs that we've lost in 2 months. Again, nothing that we could have seen coming, nothing that we've seen really since the Great Depression from an economic standpoint. Now, the job loss and the economic impact has not been equal across states and across markets. When you look at this graph here, this looks at both the absolute total number of jobs lost as well as the percentage of the labor force. So Georgia has lost about 1.25 million jobs, but that represents almost a quarter of the labor force. Georgia being the state far to the left here. You look at a market like California, only about 12% of the labor force, but again, on an absolute basis, that's 2.5 million jobs. Tons and tons of jobs being lost. Colorado, we highlighted as well, just under 1 million jobs lost, but only about 10%, sorry, only about 4%, sorry, about 10% jobs lost and about 400,000 in total job losses. So again, different states are reacting somewhat differently as the shutdown has impacted different markets. What have we seen from the financial markets? Well, we certainly saw a major step down in March. The S&P 500, the Dow Jones fell off precipitously. But again, the stimulus both from the Federal Reserve and Congress has really pushed the equity markets, the stock markets back pretty close to where they were. I think the S&P was dabbling with about 3,000, which is not far off from its overall high seen in February. Interest rates have remained low. The 10-year, I think, is around 70, 75 basis points. So in a traditional setting, that would be a very good time to borrow. But what we've seen is that borrowing covenants and loan covenants, Julie could certainly talk more about this, but it's become much more difficult to get loans approved and much more reserve requirements have been added into those loans. So overall, from a 10-year perspective, rates are pretty good. But from a lending and a borrowing perspective on multifamily, things are a little bit tighter than the 10-year would appear. So why haven't multifamily fundamentals deteriorated as much as we thought they would? Well, part of the CARES Act was to put 120-day moratorium on evictions, late fees, and other penalties for loans that are tied to Fannie and Freddie. Bank regulators as well for bank loans have deferred mortgage payments for a lot of owners. Eviction moratoriums have been spread across the state level, not just for Fannie and Freddie loans, but for all properties. So there's been a lot of government reaction, both on the stimulus side and the regulatory side, to say, let's keep people in their apartments, let's keep people in their homes. And as a result, you haven't seen the significant fall off in rates and in prices either. And I would caveat that by saying we haven't seen that quite yet. Again, a lot depends on the stimulus and a lot depends on the speed of the recovery. what this first round and probably second round of stimulus is going to do is to say, let's try to delay the impact until the economy can recover. But what I'll say is that the longer the economy stays slow, and we're no longer locked down in many states, but as long as things remain at 25% capacity, 50% capacity for restaurants and bars and retail shops and barbers and salons, the longer that that recovery is going to take. So again, talking about what the CARES Act was focused on, it was how can we put money back into people's pockets? How can they pay rent? How can they pay their mortgage? The PPP was intended to keep people on the payroll. And then again, the enhanced unemployment benefits were there to help anyone who is no longer on payrolls. So again, just unprecedented action from the fiscal standpoint to say, let's keep money in people's pockets. Let's keep having people pay their rent, pay their car payments, and so forth. Again, just breaking down the second stimulus, they ran out of the PPP. I think it was 480 billion was initially authorized. They ran through that in about 2 weeks. They added another $300 billion for small businesses. 300 billion on top of 480, that's almost $1 trillion in stimulus just for the small business community. Then you've got stimulus to hospitals, you've got the airline bailouts and a number of other bailout packages. So again, just unprecedented stimulus, something we've never really seen before. And I want to focus here on what the unemployment insurance is doing in a number of states, especially states where the average wage is on the lower side of the nationwide average. That extra $600 on top of the state benefit in many states here, in this column, second in from the right, shows you what the unemployment benefit is compared to what the average wage used to be. And any of these states, in fact, all of these states have replacement rates with the additional $600 where the median employee, the median wage earner is now making more on unemployment than they were in their job. So one of the challenges and one of the interesting things that I want to focus on going through the remainder of this year is what's going to incentivize these people to go back to work, especially if these benefits get extended out. They're due to sunset at the end of July now. With another round of stimulus, perhaps they get extended into September. Perhaps they get extended into December. And what is going to incentivize these people to go back to work and stimulate the economy? And even in some of the places where the weekly benefit is not above 100%, Hawaii, Massachusetts, Washington, DC, New York, it's still pretty darn close, in the 80s and 90% of what people were making, the median wage earner was making before they went on unemployment. So it's going to be really interesting to see, okay, what is going to get people back to really start the economic machine going? And will we see job growth? And will we see economic growth, especially if this virus is still out there, if we don't have a vaccine? I struggle to find the incentivizing factor. So it's really going to come down to a factor of government stimulus and how long this can continue. So before I jump into the multifamily fundamentals, any questions from anyone on what we're seeing economically? All right, well, let's talk more about multifamily. So first I want to talk about collections. And this is aggregated data that the National Multifamily Housing Council is putting out. Yardi is one of the data providers, as well as RealPage and Entrata and some of the other large property management softwares. But what we saw in April was that about 92% through April 26th, so through the third week of April, about 92% of renters had made either a full or a partial payment. And given what we saw with unemployment, that was quite surprising. And in fact, surprising on the good end. What people were saying was, okay, April, there was a lot of stimulus, people were getting unemployment. What about May? What about May? Is this going to fall off a cliff? Well, looking at the May data, we're actually at about 91% as of May 20th. So we still have another week to go. And again, this is renters making either full or partial payments. We don't know what the breakdown is between full or partial payments, so there may be more people on payment plans than this data is perhaps indicating. But again, 91% as of the 3rd week of May, really good data on the collection side. And a lot of that, again, is based on unemployment, stimulus, and thinking about it, people are incentivized to pay their rent. One of their first desires would be to stay in their homes. Now, there are certainly eviction moratoriums, but many renters aren't aware of that, actually. So people are paying their rent. They are paying their rent for the most part on time. So from an operations standpoint, and many of you who own properties, I'd be curious to see what your collections look like. But many people, owners and operators, are still collecting rent. The question now becomes, when does that start to deteriorate? And if that starts to deteriorate? And that is what will really drive an opportunity for distressed property acquisitions and any change in the transaction market. The transaction market has been very, very slow of late. Chris, I know you got a deal done, and congratulations on that. That's fantastic. But the data that we've been tracking has shown that transaction activity is significantly lower. And really, none of the institutional operators are buying or selling, and most of the opportunistic buyers are still on the sidelines. But we'll talk a little bit more about what the opportunities might look like in the coming months.
Chris, real quickly, can you go back to that other date, the last one? Is this specifically on B, C, A? What do you got? And is this just a overview of all of them on classes?
Yes, this is national data and across asset classes. So this is data pulled out of property management software, so Yardi, but also RealPage and Entrata and some other providers. So their property management software is across asset classes. What I will say is that oftentimes smaller properties, so say a 20-unit deal or a 30-unit deal, might not be using property management software. So obviously those deals wouldn't get included in this data set. But any institutional grade property, A, B, or C class, would be included in this data set. One other thing I will say is that this does not include fully affordable units, so anything considered Section 8 or LIHTC based deals.
Thank you.
Sure. So we've seen that collections have been okay, right? 90%, 92%. Things are doing pretty well for the most part. But the data I'm about to show you dives into our rent survey, where we're calling all of our properties to find out what their rents are. And what we've seen is that the top 40 markets are already seeing declines, month-over-month rent declines, especially in some of the larger markets, New York, LA, San Francisco, Boston, and secondary markets like Denver, Tacoma, Seattle, where the state governors have taken more stringent lockdown procedures. Lifestyle specifically, those property and lifestyle are your A class, your newer stock. Those are the properties that are leading the downdraft. And anecdotally, what we've seen is that a lot of corporate rentals have been vacated practically overnight. For example, in downtown areas where high cost of hotels would lead companies to rent apartment units for their business travelers, those leases have been canceled practically overnight, and typically those are in the upper end of the apartment stock. Looking at some of the smaller markets, places like Midland, Odessa, the oil patch and the Permian Basin, certainly as oil has gotten crushed, so too have rents in that market. Also, the leisure and hospitality markets, places like Reno, Savannah, West Palm Beach, Orlando, Las Vegas. Those markets are feeling the pain quite quickly as well. So with that, let's jump into the data. But again, looking at month over month, I think is key right now. For as long as I've been analyzing markets, and certainly through the last cycle, we've been looking at year over year. What's the fastest growing markets on a year over year basis? on a trailing 3-year basis. But with a shock to the system, a shock to the economy, as significant as we've seen in the past 3 months, we really want to focus on the immediate, on the month-over-month changes. And that's where we're looking now. So overall, again, places like Queens, Denver, San Diego, LA, quite expensive markets, but also markets where local authorities have locked down and taken really stringent measures to slow the virus, and as a result, slow the economy. On the lifestyle, again, places like Tampa, St. Pete join the mix. San Diego, again, Phoenix, where you get a little bit more of that retirement community vibe. People have just flat out stopped moving. Tampa, Phoenix, some of these markets have been driven by a lot of retiring baby boomers, and that spigot dried up practically overnight. Now that may turn on again. People will move again. I can almost guarantee it. But those markets, especially in the lifestyle, the upper end, are going to get hit pretty hard.
Hey, Chris, I'm sorry. What's RBN? What was that? I missed that.
Yeah, good question. Sorry, I did gloss over that. The RBN, that's renter by necessity. So we would consider that workforce housing, more of your B and C class properties.
Cool, thank you.
Sure. And so I want to kind of pull out the crystal ball a little bit, as Julie was referring to. And what do we see for the end of this year and into next year? You'll see a lot of these markets, we expect to see significant negative rent growth on a year-over-year basis. Again, Las Vegas, their economy has been absolutely decimated. Most of that has been leisure and hospitality, and certainly the hotels, the casinos, the resorts have all been closed. So their workforce and their rental stock has been absolutely crushed. I do expect, though, that once this virus is under control, perhaps we have a vaccine, perhaps people start traveling again, their rent in 2021 should bounce back. San Francisco, another market, highly concentrated in the urban core, very, very expensive rents. I think you'll see an overall suburbanization or a de-urbanization as a result of the virus, because people don't want to be stacked on top of one another. That's where you've seen most of the virus being spread, in places like New York and densely populated urban areas. Add on the fact that San Francisco has incredibly high rents to begin with, I think you'll see these rents pull back. And again, a slight revision, a slight growth in 2021. Some of the markets down in the bottom right here that actually might do okay, Indianapolis. And I know I mentioned Tampa, St. Petersburg at the high end getting crushed, but actually at the lower end, Tampa, St. Pete is doing okay. A lot of their growth has been around healthcare, and that's certainly an industry that is not struggling as mightily as some of the leisure and hospitality industries. So some of the smaller markets, again, Twin Cities, Kansas City, even Philadelphia, these markets will likely do a little bit better this year and might see some modest growth.
Chris, I find that really interesting. You had quite a few of the California cities were going to get increases, and the fact that we've got rent control here, I think that's really interesting that you're still seeing quite a bit of increases there.
Yeah, and I would say, Julie, those are very modest increases. The rent control discussion is an interesting one. I'm glad you brought that up. I don't think there will be a lot of momentum right now for rent control. Certainly California, Oregon, New York have passed rent control measures, but all of the rent growth that we see this year will be well beneath that. Usually you get a lot of momentum towards rent control when you've got sky high rent growth. And you saw that in San Francisco, you saw that in LA, you saw that in Seattle and in Portland. I've heard a little bit about rent strikes and local organizations trying to incent or trying to convince renters not to pay rent. Again, with the collections, we haven't really seen that. What I do think will happen is we'll have about a 2 to 3 year hiatus from the rent control discussion. And then as soon as the market allows for those rents to start picking up, you might see 4% year-over-year rent growth. You might see 6% year-over-year rent growth. You might see specific submarkets with maybe even 8, 9, 10% rent growth. That's when you'll start to see the momentum again come back and say, okay, you know, rents are getting too high again. But as you see rents dropping, I just don't think you'll see that continued momentum for rent growth, rent control, excuse me.
Okay.
So the question on a lot of our minds right now, right? Where are we going to buy our deals? What markets should we be looking at? Before we get into the markets, excuse me, I want to focus on where and what type of properties we should be looking at for possible distressed opportunities. So markets where we've seen a lot of new development: Denver, Charlotte, Dallas, Austin. Tons of new stock have been added for good reason. A lot of job growth prior to COVID, a lot of in-migration, but a lot of deals that are currently in lease-up that have just hit a brick wall because, again, there aren't that many people moving. So markets that have a lot of new deals, those deals that are currently in lease-up will likely see some, I would say, some tension, especially if they're not stabilized quite yet. Those construction loans are starting to come due, and something is going to happen. The developer probably won't hit their pro forma. Is the bank, is the lender going to give them some forbearance? Are they going to extend the loan? Or are they going to have to come into a sale? As I mentioned earlier, corporate housing in Class A, occupancies have fallen significantly and fallen quickly in those properties. Again, if there are loans coming due, those might be a good opportunity to say, I could perhaps purchase this for 80 cents on the dollar, 85 cents on the dollar. Select Class C, and when I say select, I mean Class C that's really providing housing for workforce in the hardest hit metros, in places like the Permian Basin, in places like Las Vegas, Orlando, Reno, Savannah, Hilton Head, markets that are heavily driven off of either oil or off of leisure and hospitality, where those jobs won't just come back overnight. The jobs were lost, but it'll take significant consumer and general public confidence to say, okay, I'm ready to get on a plane. I'm ready to go back to that beach. I'm ready to go back to that casino. I'm ready to go back to that resort. And I don't see that happening very quickly. So the workforce it's going to take quite a lot longer for that workforce to come back, and therefore Class C in those specific metros there may be an opportunity for distressed investment. And finally, student housing. I'm not sure if anyone on this call is involved in student housing, but as the university concept, the university system is still really in flux, not only for the remainder of this year is practically over for most universities. What is going to happen in the fall? The Cal State system, which I think is responsible for about 500,000 students, has already said they're not going to start classes in the fall on campus. I imagine as the virus continues and as the economic slowdown, the lockdowns, or the limited capacity continues, I think more and more universities are going to take that approach. And student housing operators are all or nothing. If their students don't come back, their occupancies go from 100%, darn near 100%, to zero, practically overnight. So that might be an opportunity again as we move into the fall. So one of the questions that Julie asked about at the beginning of the call is loan maturity data and ownership contact information. So if you're looking for a distressed opportunity, you like that first model, let's find the market that has the most new construction and might be an opportunity to pick off some construction loans. This view right here is the number of properties where construction, where new development is under 50% pre-leased and loans are maturing in less than 6 months. So these developers have 6 months to get stabilized. They're less than 50% and they got to move. They're not the only show in town. So you look at Austin, you look at Dallas, you look at Denver, 18 properties. And you might say that's not a lot. But again, thinking of the constraints here, they're only at 50% pre-lease, and their loans are coming due within the next 6 months. You're going to want to know who these owners are, who these developers are, and you might want to call them ahead of time and say, hey, I understand you've got a loan coming due. Perhaps there might be an opportunity to transact off market. Again, same thing here. These are student housing loans, and this is by the bedroom, but these are student housing loans maturing between now and the end of the year. And again, if some of these schools don't go back, you look at the Inland Empire, you look at LA, and I believe that's Santa Barbara. There are a lot of loans maturing. If they have 0% occupancy, it might be an opportunity for distress. And again, this is just overall construction loans, not necessarily construction loans that are struggling with occupancy, but all construction loans. Denver's got maturing construction loans in the next 6 months for almost 5,000 units. Atlanta, just over 4,000 units. So a ton of loans coming due. And if they're struggling with occupancy, if they're struggling leasing up, there could be an opportunity for investors to come in, present offers off market, limited competition, and again, you might be able to get these deals at a discount.
I got a question, Chris.
Yes.
So could one of our students here call you and say, okay, I'm looking in Detroit. I see you have 482 units with loan maturing. Can you give that person a list of those places?
Absolutely. And with that list, you could get the property information, you could get the occupancy, you could get the ownership and contact information. And again, so you could either take it to your broker or go to the owner directly and say, hey, I know that Magnolia Flats at 123 Main Street, you might be facing a CMBS loan maturity coming due. Perhaps there's an opportunity to work something out. And this last map that I show here is the Class C workforce with CMBS loans maturing. And CMBS.
Sorry, I keep wanting to interrupt you.
Oh,
The question would be, how much would it cost for that list? How much would you be willing to pay for that list, I think is what it comes down to. But I mean, what do you think there, Chris?
Yeah, and that's one of the questions that I hope you and many people on this call can help me work out. I'm trying to develop a new product within Yardi that is tailored specifically for this tier of investors and looking for these one-off reports. And so any pricing that you could provide would be really helpful. Just as a quick overview, if you wanted access at the market level to all of this data, not just the loan maturities or the occupancy or the rent, but it's $3,500 per year per market. It's $25,000 per year for the whole country. Now, if there's an opportunity to craft one-off reports, again, Julie, like you're saying, maybe it's 250 to 500. Certain deals, Chris, as you mentioned, might be worth 500 to 1,000. So any feedback would be really helpful as I push forward to try to develop this product. And in turn, hopefully help out all of you with some of your next deals coming down the road.
Perfect, thank you.
So before I conclude here, and I know we've got about 10 more minutes, but Julie had asked me to highlight another market. We talked about Austin last month. I want to talk about Raleigh, and Raleigh's one of the markets that I think will do quite well coming out of the current downturn. Now we look at rents here are around the national average, a little bit below the national average. Month over month rent growth, as I mentioned, that's the key metric I want to keep my eye on. And excuse me, Raleigh is struggling a little bit compared to the national average. The national average month over month rent growth was down about 30 to 40 basis points. So they did take a quick hit. But if you look, occupancies remain pretty healthy, 94, 94 and a half. And I expect occupancy to fall a little bit. But again, because of the job growth and the diversity of the Raleigh economy, you've got the education in Duke, in UNC, in NC State. You've got the research triangle. You've got a growing retiree base with baby boomers moving to Raleigh from the Northeast. You've got a little bit of this happy medium where it's a very pleasant climate. It's a very pleasant business climate. It's not Florida. It doesn't have this perception of, oh, I'm retiring and moving to Florida. So Raleigh has overall a lot of momentum behind it. It certainly did before COVID, and I expect those dynamics of the economy and the diversity of the economy to really propel it through the recovery, and I expect it to recover a little bit quicker. Now the chart on the right here, all these pin dots are new developments. So you see there's a lot of new development, both under construction, those are the lighter orange pin dots, and planned, which is pre-construction projects, are the brown dots. A lot of new development going on right in Raleigh, Chapel Hill, Durham, Cary, but even some development going on out in Hillsborough, Pittsburgh, as you go further outside that urban core. And that's what I really like to see as secondary markets emerge. Are you going to see these nodes pop up in other areas of the city? And that's another thing that I want to focus on, and I would draw your attention to about secondary markets and even some primary markets. Given the disinterest right now in the urban core, because as I mentioned with San Francisco, the urban core is so densely populated, and that's really where these viruses have grown quickly. Can you replicate some of the benefits of the urban core in more suburban areas? Can you have a vibrant nightlife, restaurants, bars, even local amenities like stadiums? Oftentimes the major league stadiums will be right down in the urban core, but can you get minor sporting events or minor entertainment in some of these further out suburbs? And in a place like Raleigh, you're seeing a lot of that development, again, around Chapel Hill, around Durham, to the south. So Raleigh is one of these markets. You've got a really strong economy. You've got domestic migration growth that I expect to return faster than some other markets. And you've got a good mix of growth drivers, both for general society and economy, and also the multifamily sector. So with that, I'll kind of wrap up. And if anyone has questions, I'm happy to take questions. And again, please feel free to reach out. You can email me, you can call me, and I'd be happy to set up a call where we can talk through a specific deal you're working on, specific market that you might be looking at, and we can dig a little bit deeper into the metrics that Julie mentioned at the beginning of the call, like rents and occupancy, new development, expenses, as Tim mentioned, loan maturities, who do I call, how do I target a deal? Any of that, I'm certainly happy to talk. So I'll bring my camera back to the screen.
One thing I would want to have you bring us through is what's your contact information?
Yes. Let me see. Julia, I have to apologize. I had the wrong slide in here. I don't have my contact information.
No, that's no problem.
But why don't I do this? I will. I'll send it over to you, and you can distribute it to the team. Or if everyone's comfortable sharing their email address, I'm happy to send my contact information out just after this call.
Okay. How about just a quick, Chris? Could you just say your email address, just so that people can write it down?
Absolutely. So my email address is chris.nebanzahl, and you've got the spelling of my last name, but it's Nebenzahl at Yardi, YARDI.com.
There you go.
And I'll give you my direct cell phone as well. It's 720-329-1928.
That is fabulous. You know, we have about 5 minutes, you guys. Yes, it is recorded, Daryl, so you'll be able to go back and see this. Also, Chris will be providing me with slides, so you can use that as well. Does anybody have any questions? Has your idea now about what your #1 most important rating, I guess, or what you need from Chris, has that changed? Is it still the same as the question that I asked at the beginning, which is #1? I think you guys, we went with recent sales. So would that be remaining the same? Do you see that there's other needs after this information was shared with you?
I think loans coming due seems pretty important.
I agree. I agree. There's just some opportunities where we could do some possible assumptions and potentially get you a supplemental on top of that. So I agree with you on that, Rick. I think it's also a different strategy than what other people are doing. So if you can be the first one out of that box into that market, I think there's some real value. So thank you for that.
Mm-hmm. And just one comment. I was kind of shocked to see, Chris, year 2, 2021, the actual, fairly positive rent growth in certain markets. Like, I know, you don't have a clear crystal ball, but, Phoenix at 5%, I think is what it was. LA, like bridging on like almost 4%. That's not bad rent growth.
Mm-mm.
Yeah, and I think we will see that bounce back. In a market like LA specifically, where there's not a lot of housing supply, a lot of housing stock, I think you'll see the bounce back a little bit steeper and a little bit sharper. Again, once the economy can kind of get back on track, I think you will start seeing more momentum with landlords pushing rents. Right now, not only can you not really push rent from a regulatory perspective, but you also don't want to be the landlord that's out there, really gouging their tenants. But I think most of us have a pretty short memory when it comes to rent growth. So if the economy is back in a pretty stable setting next year, I think you will see some pretty heady rent pickups in certain markets. Phoenix is another one, and we're actually working through our forecasts again with new information. So these markets may change a little bit, but Phoenix is another one where there has been a lot of demand, and so if that demand continues, then I do think the bounce back will be pretty quick. On the flip side, if this continues, if the economic downturn continues for another quarter or two through the end of this year, and some of those jobs don't come back for a long time in Phoenix, then you'll see that trend reverse and you won't see significant rent growth in that market.
All right, thank you.
Anybody else? Oh, I know that there was some question about using the some of the data that you shared. Are there any limitations for using that slide?
No, the slides are in the public domain. So if you're going to use it, either in a presentation, just let me know. But that's totally fine.
Yeah, always quote the source as well. I guess would be the thing there. So, well, I am so excited that you got to spend an hour with us, Chris. You are so invaluable. You live and breathe this stuff, and we just so love when you're here. So appreciate that. And we'll look forward to having you in June. So you can share with us May and moving forward where the stimulus package is, where we can think about rents, if there's any other ideas on that, and so forth. So if there's nothing else, I'm going to close it up. Again, I want to create value. If there's anything that you need from me, please take the time and reach out. I'm happy to take calls. I'm readily available for you. I want to make you successful. So let me help you be a better investor. So without further, I will sign off for now. You guys, we'll see you next week. Thank you so much.
Thanks very much, Julie.
You're
Thank
welcome,
you.
Chris.
Thank you, Chris. Great.